Namaskar, my name is Gajanan Joglekar. Thank you for watching my first part on stock blog called Stock Investing Science or Luck. It was uploaded in the third week of May and it was well received by the investors and has now about 11,000 views. In continuation with that blog, I will discuss today stock investing, the other aspect of it, active versus passive investing, and when to switch a stock. First, the disclosure: certain names of the stocks will be taken. My intention is not to defame that company or promoters or management capabilities. There are various participants in the market: a short-term trader, future and option investor, retail investor with only 2 to 4 months of horizon, a retail experienced investor who will buy stocks of good companies from good management and industrial houses, and he'll keep it there for a number of years. Some will book profit, most will only keep investing in the market, and they will never take a check from the broker. We have all aspirations as investors. We want our folios to grow. We want alpha returns from the market. But when the situation turns that our stocks have really grown, we never think of booking any profits. For example, long term is good. But if individual who was like say 35 or 40-year-old had invested then in Infosys and his shares have grown to anything from 2 to 4 crores depending how much he sold in between or not. Now his wealth has gone up, but he received only dividends which is in cash. Otherwise the profits are still on the paper. But he has also grown from 35 age to the 50. So your youth is gone. So when we have aspirations, it is important to book profits and do something else. Book profit and maybe invest in PPF, buy a new car, buy new expensive gadgets, go abroad, take a tour, give your kids best education. So many things can be done. But my experience is that most investors, they prefer keeping their portfolios growing, and most, including me in the past, have not been able to book profits and taken a check from the broker. And whenever I have taken, the markets have only grown. That is the fact of the life. But active versus passive investing, buying a stock and keeping them for a number of years is good. But you need to take a relook at your portfolio from time to time. And there are many number of occasions you will find a certain stock which has delivered or mind-boggling returns. You need to exit it completely. There was an oil and gas related company. Its stock had grown about 30 or 40 times in just 3 or 4 years. So after the oil crash from 2008, the stock lost almost 60 to 70% value. A realty stock whose managing director was involved in scam and corruption, when he was arrested, the stock has lost almost 70-80% value. And these are not small caps, these are large caps. So if someone had booked profit and got out of it, it makes a sense. Now passive investing for long term sometimes can create a problem, and you can lose lot of money or notional loss from the top of that stock. Active investing is good in the sense you spot opportunities in the market, you come to know something new, and there are always opportunities in the market. Lot of experts say don't watch business channels, it is of no use. But no, in my opinion, ticker tells you something and you can learn lot from that ticker. But you need to remove lot of unwanted things from the TV channels, from the business TV channels, if you are a long term investor. But for short term investor, active investor, sometimes it can really help. You spot new opportunities in the market. For example, I will give you, let's say Reliance Industries, because of various issues with the company, petrol pricing, D6 gas field, company has not done well for past 2 to 3 years. And let us say there is an investor who is holding about 1000 quantity after many years of holding them. He has been original allottee of the Reliance, and let's say he got so many other mergers and acquisitions and bonus. Now he is holding, say, let us say 1000 quantity. Now somebody tells him buy Page Industries stock, the owners of Jockey brand. Now 2 years back, Page Industries was just at 1000 rupees. It was already giving higher and higher dividends. It was showing higher and higher net profits. Company had excellent shareholding pattern. Lot of private equity investors, mutual fund like IDFC Premier Equity, they were having stake in the company. Company almost every quarter was giving dividend. So let us say if you are a long term shareholder of Reliance and somebody tells you to buy Page Industries, you can be little bold and buy, let's say, 100 shares of Page Industries. Here there is a company which is having about 40 or 50 earning per share. Out of that, they are giving almost 75 to 80% as dividend payout. While Reliance is a mega cap and there is a kind of slowdown, so why not switch from, say, about just 100 shares from Reliance to Page Industries? Page Industries now is very expensive stock, and it is current market price is almost 14 to 15,000 rupees. So in my opinion, equity itself is a risk. When you have a grown up portfolio, then it's become a very challenging task to manage your portfolio, and if you are a retail investor, more so, because you cannot time the market. But with little bit of information at your fingertips from internet, if somebody tells you that ABC company is good, think about it. You cannot have a perpetual capital to buy stocks from various recommendations which keep coming in on the business channel, on the print media, from your friends, from your broker. It is just impossible to keep investing money in the market. So the only option left to the investor is like to have a relook at your portfolio and think about a stock which can underperform for some time and switch to a little better stock, a emerging mid cap or emerging small cap with good dividend payouts. Of course, there will be a risk. Your every step and every action may not culminate into profits, but there are always good chances that you can get alpha returns. Now Page Industries from 1000 or even 2000 to 14,000 is not a bad idea. So like that, active investing and passive investing has its own advantages and disadvantages. Now coming to the active investing, a person looking at stock prices daily, he forgets the bigger picture coming in for next 2 years or 4 years or down the line for a decade. For example, Page Industries was bought by investor at 1000 and was completely sold out at 2500, thinking that it is very overpriced. But the stock continued to gain, the company continued to show net profits, they continued to give higher dividends, and though it carried a premium, nobody booked profits, and stock is sitting pretty at 14,000 rupees now. So active investing does help, but at the same time you must not forget about the big picture or macro picture in the market and sell everything. So these are the pros and cons of active versus passive investing, and when to switch a stock. I will give you another example of a switch. Sometime back, LG Equipments gave a bonus of 1:1. It was there some jubilee year or anniversary, and company said in the corporate announcement, because we completed so many years, we are giving bonus 1:1. The stock price then was about 180 rupees. It was the stock went up immediately after the bonus announcement, but I realized the stock management has thought of giving bonus because of the completion of number of years. Probably the business prospects are not so bright, because then infrastructure stocks were down, Indian economy was slowing, it was not growing, interest rate cycle was very high. So I found a stock, Atul Limited from Lalbhai Group. It was around at same price, 180 rupees, 190 rupees. Why LG Equipment dividend was very low, Atul then it was giving 4 rupees or 5 rupees dividend. It was emerging mid cap, they were investing in a lot of facilities, the group was good, LG Equipment management also good, but because of the slowdown in the economy, the profits had stagnated. So I decided to switch from LG Equipment to Atul Limited. Now LG Equipment has not grown much in last 2 to 4 years because of the problems which I told you, but Atul Limited has done well and is sitting pretty above 1200. So like that, you always take a look at your portfolio, decide whether anything can be sold now which will underperform in the market, and whether there is any bright spot which needs to be bought out immediately. That is all I want to say about pros and cons of active investing versus passive investing and when to do a switch. It's a short video. Thank you for watching again. Please do watch and share the video on YouTube. Thank you so much. Happy investing. All the best.